extension is called the golden ratio. This is where price usually has a hiccup, or it reverses directions. It has some type of pause there. So if we do run up, that's the level that, a lot of people can lock in some partial profits, or just expect it to have a pause and a pullback. And if it does pause or pull back at that specific number, it usually means we're going to go up and hit the 100 level, the 100% measured move. And that is simply based on this rally, this straight up rally from the previous low, the flagpole. That is the same 100% distance to the next target. A bull flag is a halfway point. So once you've seen that bull flag form, you're like, okay, half of the move is done, but we still have the second half. And so that gives us to about 4,100 an ounce to the upside. Expecting we're going to see silver run up to about 38.50, have some type of little pause or hiccup for a few days, and then probably have some blow off move for that second half up to about $40.60. And I think gold and silver will do these at the same time.
Bullion remains one of the year's top performing assets, still up over 25% in 2025, trading just $170 below its April record. Ongoing geopolitical friction and rising trade tensions have continued to push investors toward gold as a traditional safe haven. The latest move by President Donald Trump, announcing 25% tariffs on goods from Japan and South Korea, effective August 1st, briefly reversed losses in the gold market, reinforcing its defensive appeal. Technical analyst Chris Vermeulen highlights two critical Fibonacci extension levels to monitor, approximately $3,700 and $4,100. He notes that gold may face resistance at the first level, but if it breaks through, momentum could carry it to the second target in a full measured move. While gold has momentarily struggled to hold above $3,300, silver is beginning to outpace it. Silver, known for its heightened volatility, has exhibited classic bull flag behavior. According to Vermeulen, the metal has staged two sharp rallies recently, each followed by sideways consolidation. If the pattern holds, silver could first rise to around $38.50 before taking a short pause and potentially surge to $40.60. Broader market dynamics also support the bullish thesis. Demand for metals is expected to continue growing amid the accelerating global shift toward renewable energy, electric vehicles, artificial intelligence, and advanced digital infrastructure. While this supports upward price trends for silver, its sensitivity to economic cycles may introduce short-term volatility. Still, with gold holding firm and silver showing technical strength, both metals appear poised for further gains, particularly if trade tensions intensify or central banks resume dovish policies. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
It's unfolded over the past 2 weeks, really. We've seen the NASDAQ break to new all-time highs, which has got a lot of people excited and bullish. It's also created a lot of people who were betting on the markets that had put in a top. They thought it's put a lot of people on the wrong side of the markets. And then a few days later, we saw the S&P 500 break to new all-time highs. And that really is kind of the big barometer for me. And now we're really starting to see people turn very bullish. And they're piling into the stock market. We're seeing lots of shorts cover. People who are betting on falling prices have to get out of those plays because now the stock market has no overhead resistance. It's at all-time highs. And we're seeing money pile into growth stocks. We're seeing, NVIDIA's breaking to new all-time highs. The small cap stocks are on fire. So people are moving into risky, fast-moving companies because they want to make a lot of money. And, when money's going into growth stocks, it's usually coming out of somewhere. It has to come from somewhere to reinvest, right? And so we've been seeing gold and silver. They've been trading sideways. They're slightly lower over the past couple of weeks, really. They're taking a bit of a breather still. And I think we're going to see gold and silver move a lot higher, actually, still. I think as soon as the stock market, this little wave of the all-time highs, causing people to cover their shorts and FOMO, people who missed the whole rally saying, I got to get in now. It's like they're chasing pricing higher. Once that wave fizzles out, potentially over the next week or so, I think that's when gold and silver will actually start another leg higher. I think silver could go to about $40, $40.80. I think gold could rally to about $4,090 an ounce. So I think we're getting close to a nice move in gold, but right now it's just taking a breather. Both metals are just chopping sideways as money rotates into more exciting stuff. People love to chase stocks. So we'll take a look at the chart of gold here real quick first. If we take a look at the chart of gold, and if we just zoom back if we just zoom back a couple of years here, more or less we've seen gold have a series of, it has a rally and then we tend to see it consolidate sideways for a while. These are very bullish types of price patterns. A lot of people get nervous that they become bearish on things, but what happens is, gold has a series of rally, pause, rally, pause. These pauses, these rallies and pauses are called bull flags. If the price goes up, it creates the flagpole, and then price flags sideways, and it creates just a pause. The market's recalibrating, rebuilding energy before it starts that next move. And that's where we've been really for the last several months for gold. It has this big move. And as you know, Elijah, one of my favorite tools is Fibonacci extensions, which Fibonacci theory, if you look up the number sequence, it's in everything in the universe. It is super powerful. And there's a golden sequence that I like to follow, which it's also called the golden ratio. If we just look at this last rally up to the high that we saw several months ago and the strength of the pullback, and we kind of carry that forward, we can get an idea where gold should rally to next. And it is showing about 3,700 is the next upside kind of surge for gold. And then they'll probably pause around there. The 618 extension is called the golden ratio. This is where price usually has a hiccup or it reverses directions. It has some type of pause there. So if we do run up, that's the level that, a lot of people can lock in some partial profits or just expect it to have a pause and a pullback. And if it does pause or pull back at that specific number, it usually means we're going to go up and hit the 100 level, the 100% measured move. And that is simply based on this rally, this straight up rally from the previous low, the flagpole, that is the same 100% distance to the next target. A bull flag is a halfway point. So once you've seen that bull flag form, you're like, okay, half of the move is done, but we still have the second half. And so that gives us to about 4,100 an ounce to the upside. And we're in this unique situation, very similar to 2007, just before the stock market, actually just as the stock market was making new all-time highs, just like we are right now, gold started to come to life and gold had one more big push higher. And so there's a very interesting, chart setup, very similar to that time window. And we could see gold and silver have this big push to the upside over the next 2 or 3 months. Could be pretty explosive. And that would probably also mean the stock market is stalling out and going sideways or pulling back. Now, if we take a look at silver real quick, silver's down about 1% today. Gold's down about 1% as well. Silver has a very similar type of price action. It's more volatile. It's usually kind of more explosive. We have a rally up and then it's flagged sideways. And we've had a rally up, it's flagging sideways. And with the same type of analysis, we can take the lows up to the high and we can come back down to this recent low. And it gives us these levels to draw for silver, which is about $40.60 somewhere in there. So I would expect silver over the next, now this is the daily chart. So over the next month, over the next 20 bars, I'm expecting we're going to see silver run up to about 38.50, have some type of little pause or hiccup for a few days, and then probably have some blow off move for that second half up to about $40.60. And I think gold and silver will do these at the same time. Silver's come to life. It's played catch up with what gold has done. And I think both of them are a good play. I don't know which one is the better play. I think gold is more consistent. You're probably a better possibility of gold hitting those targets than silver is. But silver has got that percentage move. It moves faster. So I like both of these because they are a metal. Or they're commodity, they're outside of the stock market. And if the stock market actually gets weak, we should actually see money want to move into physical metals. So, and we're in a unique situation where there's enough uncertainty and stuff going on that gold and silver are going to, I think, want to keep going higher anyway. So I like the precious metals space here. I thought the metals were going to top out several months ago, but instead they've formed this beautiful this bull flag pattern, and it's actually now pointing to higher pricing. So that's kind of my take on both of those from a technical standpoint.
After delivering its worst performance since the Nixon era, the US dollar enters the second half of 2025, facing a range of structural and geopolitical headwinds. The dollar's recent weakness coincides with intensifying debate over the sustainability of US dominance in global finance. With the public share of U.S. debt nearing $30 trillion and the federal deficit on pace to hit nearly $2 trillion this year, skepticism is rising over the long-term viability of American assets, including the dollar and Treasury securities. This erosion in confidence has already begun to shift capital flows. Global central banks are increasingly seeking alternatives, buying gold at a rate of 24 tons per month, according to the World Gold Council. The move reflects both a desire to diversify reserves away from U.S. assets and growing concern over inflation and monetary debasement. As a result, gold has posted its strongest first-half performance since 1979, another era marked by high inflation and geopolitical uncertainty. Chris Vermeulen cautions against writing off the dollar too soon. He notes that while sentiment has turned sharply negative, history shows that periods of broad pessimism often precede a rebound. If the U.S. economy stumbles or enters recession, global investors may once again seek refuge in the dollar's relative stability. He emphasizes that in times of financial stress, capital tends to flow back into U.S. assets, reinforcing the greenback's safe haven status. Though challenged by long-term structural issues and a shifting geopolitical landscape, the dollar could still surprise on the upside if risk aversion spikes or global instability increases. Let's get back to the interview.
I never put any weight into it, into the gold and silver ratios. But yeah, it's funny because I remember when I was younger, I remember platinum platinum was worth more, but now it's not worth nearly as much. No, I don't trade off ratios. I trade off price action, and ratios can be out of whack for so many years, and it'll just put you on the wrong side of the trade or in the wrong commodity. Just follow price. Pick the one that has built a base and a launch pad, and it's got an uptrend and looks good versus, trying to get fancy with ratios. I don't believe in the ratio stuff. Eventually it'll play out because everything oscillates, it's a pendulum, but pendulums can be out of whack for decades in some cases, and it's your best to just follow price and stick with the best investment at any given time versus trying to play a ratio. Yeah, the dollar, it's one of the most hated assets. It's funny, if you go back to the stock market top in 2007, we actually saw gold was hitting new all-time highs. Everyone loved gold. Is in a strong uptrend, just like it is now. It's undeniably, do not bet against gold. Lots of uncertainty going on. And the dollar had gone straight down. It was crushed. It was so hated. It was one of the most hated assets. You look at what's going on right now. We've got the stock market showing signs that it's overvalued. It feels like it could top significantly at any time. Everybody's moving into gold, or not everybody's moving into gold, but gold is moving higher, hitting all-time highs. And the dollar is in the dumps. It's in a downtrend. Everybody hates it. And, that's usually these are turning points, right? When everybody loves one thing and they hate the other and they're beat up and they're both at extremes, usually there's going to be some reversion to the mean, some type of reversal, whether it's a bounce in the dollar or a big rally. I'm not sure. But if we do go into some economic recession, something big, the dollar will probably come back to life. The U.S. Is a powerhouse. There's no doubt about it. And when things get ugly, the dollar tends to do pretty well. You don't want to bet against the U.S. So that's what I think. I think the dollar is going to have a strong bounce. I think the equities market and gold will eventually put in a top, but you definitely don't want to fight these trends. Wait for these reversals, because when these reversals happen, all these assets will actually be a very good trade. You just need to make sure you trade with the new direction. Sentiment has really shifted among investors. A few months ago, as everything was falling apart and the tariff talk was killing the stock market, everybody was looking for safety. Everybody's investment accounts were down sharply because, of course, everybody believes in always diversifying and holding on to stocks and bonds, and they just got beat up. We're in a phase now where the markets are going higher. And in a lot of cases, it's not because people really know what they're doing when it comes to trading or investing. It's just they're naturally told to invest and diversify. So they're in the markets. So when the market's going up, they know what they're doing because their account's going up. But the reality is people don't know what to do in the markets. They don't realize, very wealthy people are forward-looking, they're proactive, they front-run and look for problems coming so they're ready for when they do happen. And if they don't happen, it doesn't matter. At least they have a game plan for if and when it does. And so right now, people are seeing the markets at all-time highs. They don't see the risk. They think we're starting a new bull market. They think because their account's going up, they know what they're doing. And this is the reality. I've seen this happen. I've been doing this since 2001 with investors, with my investment newsletter. And it's the same cycle over and over again. People don't most people don't do anything until they're losing money, until the markets are crashing. There's red bar after red bar, and they realize they don't know what to do and they're scared. But we're in an environment right now that if you're not scared right now and you're bullish, you should be scared. I mean, you're way better to be a nervous investor and have a game plan for if the brown stuff hits the fan and it never happens, than it is to be someone who's just riding this up blindly thinking you know what's happening, and then a piece of news or something comes out and your account just loses 20 or 50% over the next 4, 5, 6 months. So people just need to have a game plan, realize that you have to protect your capital. Buy and hold is not a way. Eventually, we're going to hit a big bear market, and it's going to cost you 5 or 10 years of no returns and severe stress and drawdowns, losses. So just people need to educate themselves on what to do if this market, and when it does, eventually we'll have one. So it's not a matter of if, it's just a matter of when. Have a game plan to move to safety, even cash. Cash is a position, especially when everything's falling. There's nothing better than earning 4% interest when everyone else's accounts are falling and everything else is dropping in value. So that's kind of what I like to share.
Against the backdrop of mounting economic uncertainty and escalating trade barriers, precious metals remain a shining beacon as both a technical and strategic refuge. Gold's steady ascent and silver's bullish momentum reflect more than just market speculation. They echo a broader realignment of investor priorities in a world where monetary policy, sovereign debt, and geopolitical power are all in flux. As institutional demand grows and reserve diversification accelerates, the traditional boundaries between currency hedges and speculative assets begin to blur. Meanwhile, the US dollar faces a credibility test that could either reaffirm its global role or hasten its erosion. Are gold and silver rising due to sound fundamentals, or are they signaling deeper fractures within the global monetary system itself? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.